This recent IPO, I would not have bought it at 1/5 the price. I'm not telling you which one, but you know which one. Why will I not look at every fellow's webinar who's in my industry? We will look at Marcella's webinar and White Oak webinar, and from some we learn what to do, and from many of them we learn exactly what to short. Our conviction, we say, is higher in things that we don't own than in what we own, because we are starting by rejecting.
Hi Samir, thank you so much for coming on the Sensei Kujaku show.
Good to see you. Thank you very much for inviting me.
So Samir, there's obviously a lot I want to get into, and I'm really excited to have this conversation. But before I start any of that, I actually wanted to thank you for agreeing to do this. And the reason I say this is I emailed you sometime back when the only people who watch my videos were my wife and my dog, and you agreed, and you agreed to come on. So I mean, genuinely, I really.
No, you're from Penn, and I'm also from Penn, so that's good.
Yeah, exactly. So Samir, why don't we start talking about investing? And I want to talk about different topics in that. The one thing that has sort of struck me whenever I listen to you talk about investing is how you sort of make investing look simple but not easy. And what I mean by that is there is this interconnectedness that you seem to sort of see maybe better than most as to various events and things that are happening in the world. So I want to get your sense of why it is that you think you can sort of connect those dots and figure out that there's a butterfly flapping its wings somewhere in the world, and how that's going to affect us here.
Not so much, but in general, I would give some credit to the fact that I read a lot. And in reading, many people say, do you make notes? And I don't do all of that, but because I read a lot, both books and news and US stocks. And over time I realized, because in the early days I made a lot of money just by saying that whatever is happening in US plus minus 12 months will happen here. And the first example was that in the 90s, when the US cigarette stocks were being hit because of massive legal settlements, I refused to buy ITC in those days, even though people would say, what is the connection? India doesn't have this legal risk. And I used to say that the fund manager, having lost a lot of money in the 90s on Philip Morris, when this thing happened, I think the stock fell 26% in a day or something. So I said nobody's going to say I lost money in Philip Morris US, so let me go and see if I can buy a cigarette stock somewhere else. So that search for connection or looking at another market to see if it can happen here, I mean, that was just my starting days. But in general, I think reading has led to connecting. And I'm telling you, there are many, many examples which, if I just think, I'll be able to give you, where reading something here led to something else there. But first is, you also have to believe that this idea that you will buy and get so our conviction, we say, is higher in things that we don't own than in what we own, because we are starting by rejecting. And therefore our loyalty is more to the fact that we don't like this fellow rather than that we like that fellow. So if something goes wrong in the things we like, which was a residual of the conviction, we don't have any personal issue in getting rid of them at short notice.
Okay, so that's an interesting point that you brought up, which is you first reject and then you select. So I want to understand, what are the basic things on which you would reject a company? I mean, is it just governance, valuation? What else is there?
So the first is, big picture is to accept that if there are 500 stocks in a universe, whether you find the good guys or you reject the bad guys, in the end you'll end up in theory in the same place. But the problem is that there are no definitions of good. The definitions are mostly of bad, because the bad can be a few things and the good, there is no end. For example, you may say that an employee is bad because he steals money. But if he doesn't steal money, then that point is irrelevant, but that doesn't make him good. Actually, I can tell you that you cannot tell me a definition of a good employee, whereas I can tell you the definition of a bad employee by giving only 1 point. Let us say he harasses women. That is bad. If he doesn't harass women, doesn't make him good. Then you'll say, what next? He works hard. So if he works hard, is he good? We don't know, because he might be a bad influence on some younger, not motivating them, any reason. But if any of them, he's not a team player, let's say. So the bads are easy to find, and in the end, if the universe is some X number of stocks and you find the bad and reject them, you end up mostly landing up with the not bad, and many of them will be good. So we found that there are 8 factors which ex ante you can check to see that whether this stock may underperform because of this factor. So one of them is size of market. If it looks very small, which we call theme, we don't like. If the industry is very competitive, or basically a bad industry, or government has a big role, or policy of government has a big role, or government is a customer. Now many people say, but in bad industries also you can find good companies. But we don't like to do extra effort. Once in a while we may also land up saying, okay, this company is beyond its definition of industry or something, but broadly, why are we doing extra work to find it in a bad this thing? The third, we say potential for disruption. Like today we might say that for theaters, or we might say that for two-wheeler, that they are getting disrupted, and that at various points we may say for different things. Previously we never had this as a separate point, and we made it as part of industry in general. That. But then because disruption, everybody talks about it, so humne kaha ki let us specifically deal with it. Fourth could be bad known history. We are not talking about trying to find somebody's bad history, because how will you find it unless you come across it? But if you come across it, or somebody else comes across it and announces it that this guy has bad history, and you read it, it's enough. That's now your knowledge also. So bad history or governance. Or if we think that the strategy is that he's too aggressive, let's say he's growing without regard for efficiency, but he wants to grow for growth stage. So what we say, strategic difference between what we think he should do and if he does. We are not changing him, we are just moving away. Or bad expected results in the 1 year plus kind of thing, not necessarily 3-4 years. But let's say we didn't buy in the last 3-4 years HDFC AMC, because we knew that the results will not be exciting. It's not that the history is bad or the theme may be bad or whatever. And the last is very high valuations, which are not out of line with history of that same company or the industry or whatever. The point is, enough number of companies do well, so you can reject enough number of companies and still have enough number of companies left which will do well. And to reach them, you can either start by saying, I like to find the best companies, or to reduce the cost of error, say that first I will eliminate whatever I can, and from what I cannot eliminate in simple analysis, then I will search for the good.
Right. So there's one particular point I want to talk about which you spoke about, which was governance, and everyone loves talking about how they avoid the quote unquote, not clean companies, ye chor hai, all of that. There's one incident I want to tell you about which I think really made me question what is a chore, and can we actually gauge whether or not a guy is a good actor or a bad actor. I remember a few years back at an investment conference, I was meeting the management of a company, and at this distance, this man spent half an hour talking about all the bad practices in the industry, how there's bad actors, people are doing the wrong thing, it's about time there's a cleanup, all of that, right? And a week later, this guy gets caught. And I kept thinking to myself, I mean, either he's not actually bad, or I mean, how is it possible that he's so convincing and makes you question what is good and what is bad, and even if after he goes out, you've just cut the head, but who knows what is beneath him, right? So how do you think about that?
So that's what I'm saying. The thing is that it is very difficult to find a bad corporate governance where so far there has been no visible evidence or any reason. So that's why I am saying, let's talk first, remove the known bad, where there are people who, I want to name on your podcast, but everybody knows, but many of them will buy those stocks saying that this is discounted or that the valuations are very cheap. So we say that there is no need to make these trade-offs because the number of companies that do well in a market relative to the market are about 150. That the 150th best stock of the index, I don't think in India any fund manager, including me, has in any year got the performance of the full fund same as the 150th best stock of the market. I think I've done it in 2-3 years out of 18. So you are not able to even get the performance of the 150th best stock, which means there are enough stocks that do well. So why do I need to make the trade-off that he is bad but everybody knows about it, or that he is bad but it's the same as saying it is cheap because of that? There is no need to do that. So we are talking about the known guys who again and again have hurt investors. Like now people have discovered that China is bad for investors because the government has targeted and made you hit various sectors. The same thing with individual companies. But look at it even differently. When some news breaks out on some fellow being raided or somebody being charged for some big issue, many times the stock trades 3-4%. Recently Siemens had a corporate governance issue, according to me, that they sold X% of their one of the businesses at some 12-13 whatever P, when the whole company's market cap is 60p. Today the price is higher than that day. So who are these guys who, I guess in theory, did not have the stock one day before this news, and after this news came said no, now is our time to buy because maybe first day it corrected 3%. That's what I mean. Why would people go in and say no, income tax rate has happened, but we know these things happen, but it has corrected 1%, so now I can buy. If it was 1-2%, you could have bought the day before. You were waiting for an event whose impact is 2%.
I guess they're waiting for the market to instruct them. If it's 2% means not so bad, if it's 20% means something's really bad.
Yeah, that also that also may be right.
Yeah. But so you spoke about valuation.
But by the way, one formula which I suggested to all the companies which do bad things is that the day after that news comes, do whatever it takes so that the stock does not fall. Because that evening then the world will say that this news is discounted. And they will move on and forget about the event. So we have to not forget those events.
Right.
And that is how we are using that line. We are not saying that every time we are finding and doing investigative journalism and doing recorded cameras. We are just saying that wherever there's an inventory of bad things that have been done, at least put that down. And
yeah, and you spoke about valuation and whether something is baked in the price or not. So I want to understand that when you are evaluating a company, so you've passed the elimination point and now you're selecting and you're looking at, okay, there's company X and we like it and so on, and we need to figure out whether it's the right price or not. I mean, does it boil down to DCF? Are you looking at a very complicated
DCF is in very few cases where the predictability might be high. But in general, the valuation is based on whatever the analyst can use to justify it or not justify it. So for example, we bought in 2016 and we still own Westlife, which is McDonalds India. So at that time, now its market cap, I think it's just about $1 billion or maybe a little less, and that time it must have been 400-500 million. So now there is no profit, and the profit, actually even now there is no profit or very little profit. And so how to justify or how to even talk about it. So we and the analysts, we looked at it together and said, let's look at so it is West and South, this Westlife. And then there was a private company in the North and East. So let's say this guy's market cap is 400, you double it and say that you can get McDonald's India franchisee at 800 million because half is unlisted and half is listed. And it's not owned by McDonald's India, it is only a franchisee, but a long term, like at that time it was till 2028 or 30 or something. So double it to say if it was McDonald's own company, it would have been 1.6, who knows. Now compare Indian subsidiaries valuations related to the parent and put down every company where we have this thing that it's basically it's like a global company. So Nestle India to Nestle, Colgate India to Colgate, Westlife India to actually it was not Westlife India, McDonald's India, but by doubling it we treat it. So like that we said it is very low at 1%. Most of the guys are 5 to 10 to 15%. And otherwise, we like the opportunity that people will go into branded things and the young will go and small ticket, whatever. Now, where is the P? There is nothing. But when you buy, we buy 30, 35 companies. And the newer companies, we buy 2%, even 1.5%. We are not saying that we will buy 7% or nothing. Suppose I want to buy only 15 companies, which means, say, let's say you're buying 7 or nothing. You cannot do it. You'll say, I'll wait 3 years till I can see perfectly how it is being implemented or how it is being, localized. So you have to think for various companies, various things. At the same time, we own companies which have very high growth and loss making, and we are willing to buy a very cheap company at 4p, because the idea is each has to be justified on its own this thing. I recently, after many years saying that I'll never buy Indian PSUs and oil and gas, about 3 months ago I bought HPCL also at 235, saying that it is so cheap. The guy told me, one of our guys, that it is cheaper than Zomato, which also I own.
As in terms of overall market cap.
And he said, see the size, these guys will make 1 billion or 7,000 crores they're supposed to make this quarter. Okay. And then of course you needed a little bit of a macro, that previously the government would, as the prices of oil fell, immediately ask you to pass on the cut. But here, because previously they had made losses, effectively the government has allowed them to recoup everything. So in that sense, although they will not make obscene profits, but over the next 6-9 months till elections come, the fact that so many distributions, so many points, volume of this size, and also because last year the value stocks had done well and I had felt that I have less of the value stocks, I said 2% I don't mind. And the clincher was that its market cap, after having this and that and reach and stores and whatever, is less than Zomato, which also, by the way, separately I like. So what I mean is, basically in the alliance system, we had the thing that the analyst has to convince the fund manager. Whatever he wants to use as his logic, he can use. Instead of saying for every company do a DCF or for every company do this.
Yeah, it's actually what happened with Zoom and Exxon, right? In COVID, Exxon collapsed and Zoom, everyone was using it, so it was like this and this. And then that was actually the ultimate pair trade of 21, where you went short Zoom and long
So
Exxon.
my idea is that I want consistency in my year-to-year performance also. Not just say that I do A, and for that A, I will wait for the cycle to turn and then be proven right. I don't like that model, because why can't I have one stock because it is very high growth and therefore maybe a little expensive by some measure, and the other stock was incredibly cheap. There are fund managers who are less qualified than me, or maybe same, or mostly less, who are investing in 40 countries and saying I buy equities and then I also buy debt and then I buy commodities and I buy gold. Why? And I sit in one country or buy in one country where market cap is 2% of the world, and in that I say I buy only 10 stocks because I only do growth, and then another fellow will come and say I only buy value. But I can buy one of your stock and one of your stock. What is the problem? So that is how the consistency has come for us, because you are not exactly knowing whose turn it is next, but if it can be justified on its own, it can't be how can you have this and that in the same portfolio. You're supposed to have.
Yeah, and so you spoke about QSR, and I think what's sort of happened in, say, the last 6 months, 1 year is companies that are domestic focused have done well, and companies that are predominantly export focused have struggled. And so obviously if that was how your portfolio is positioned, you're happy now. But if you look at it from a slightly larger, bigger picture macro sense, do you think that it is absolutely essential that, say, specialty chem, pharma, IT, if you take as these three broad export-oriented industries, that it is absolutely essential that there is some sort of recovery? I mean, whether it's 6 months or a year from now, I don't know, but that recovery is needed from a overall
for macro, yeah, standpoint. And it will happen.
What makes you say that it will
Because
happen?
in the end, for IT and all, we are the back office of the world, and we have no commitment to any one technology. So whatever is happening, we can learn and implement. So big picture, it will always be needed. Specialty chemicals will always be there because China, people are wanting to move a little bit of the supply chain from China, and initially India got a boost because China sort of gave up voluntarily some of the space by saying we are following the blue sky or whatever, the clean air and all these things. And India actually is good in engineering and chemistry and benzene and all these things which are common between our exports of IT and specialty chemicals and pharma, that they are not this absolute like blue collar job, but a little bit of engineering type input and some this thing, and therefore that over time should be okay. But if for 1 to 2 years you can step out of a sector because either like in chemicals we walked out because we are not used to 50 and 60 PE specialty chemical.
Basically, that cyclicals were being valued as secular stuff.
Clearly, and we in our previous life used to find these stocks at 6p. So we made a lot, and we still have SRF, but broadly we sold the others. And in tech I have seen it once or twice before. These guys do not think beyond their nose also, because they won't even bother that even though I have an order from the company, the guy giving me the order himself is having trouble, because he'll say for now he's given me an order. It's like Baiju giving you an order and you saying I have an order, what can I do? Well, you should read a little bit behind the scene, because last year from June when I went to Zero Tech, we recently, because we are going to do mutual fund one day or whatever, we took all our videos of what we said about tech sector, which means in July and September and December and all that last year. Basically every US company had started firing, from Microsoft, Google, Meta, and then others had warned, like Salesforce and these cloud companies and security everybody had warned. And our guys say everything is good. In fact, in January, some of the bigger guys raised their guidance. And in April said, sorry, we could not meet the guidance. You have raised the guidance 3 months ago. Why would you have to raise it?
And actually 1 month into the quarter. When you raise it,
only some 60 days were left, 72 days were left. So, but it was so obvious from a top down that it may not disappoint, but it's unlikely to be a good, but it turned out to be bad. That is a different thing. And now, just this weekend, which is 3-4 days ago, 7 Indian brokerages have downgraded earnings for IT sector. That is including Kotak and JP Morgan and HSBC and JM and whoever. How do all these 7 guys end up downgrading on the same day, not only the quarter but the year? Somebody has called them and said your estimates are too high, and everybody does it. You're guiding them down so that on the day of the result,
there's no shocker.
The shocker is between like sort of diffused because now it's still a broker report, but that day the estimate will be met or closer to that estimate. So it's obvious कि अभी तो नहीं हो रहा कुछ. So अब अभी नहीं हो रहा तो अब many people say कि next year के लिए ले लो. हम कहते हैं next year के, now that we don't have it, we have time.
And just because you brought up that point, brokerage reports, do you pay attention to them?
Yes. We pay attention to everything.
From a factual standpoint.
So we say so we say कि we may not. So we tell the thing that we want to see your visit reports, whatever you write, and the end buy sell. It depends on you versus us. But many of these guys go on road shows. Let's say they go on road shows to US. Now we are not in US. So when they go on road shows, the company meets some 20 funds. Those 20 guys ask 20 questions, and the broker is sitting there. So brokers write, without giving names, that I went for 3 weeks, or not 3 weeks, they go for 3 days, with this bank or this tech guy, and these were the questions that were asked in general, and these were the issues raised. So we got it without doing the meeting. So these things are public, and this thing. So we want these kind of things, and also new names, completely new names all the time. Something happening. I don't understand this thing that I to actually say that why will I not look at every fellow's webinar who's in my industry? We will look at Marcella's webinar and White Oak webinar, and from some we learn what to do, and from many of them we learn exactly what to short. So the point is that why should we waste that information if somebody is putting out a 20-pager report, even though it's our competitor? We will see other guys, new stocks he's bought, to say, oh, why did he buy this? And then we may reject it. But everything is useful information, and there is no this thing that he has bought it, so I'll also buy it if it is good. But our fellows have to say, yeah, this is a good one, we missed it, but there can be logic. And then we have to build the logic, because he's not telling us the logic unless he's these PMS guys who go and tell logic also. So if somebody is writing report for me and I'm not paying him anything, and he's giving me public, I have to love all this extra information. What is wrong with it? Everything is useful.
You know, it's very interesting that you have that attitude, because I mean, I don't know you, but when I observe you as an outsider, I sort of get the sense that you take life and yourself seriously, but not too seriously. And I'll tell you why I bring that up. It's that you keep your ego in check, right? It's like, you know, you think, I know who is this guy to tell me anything. I've forgotten more than this guy knows, you know. I'm saying it's phenomenal that despite your success that you have.
But that might be one reason for the success. No, who knows? The fact is that ultimately, if there are 20 fund managers and some 3 guys are buying something different, at least we can try to understand what did he find, and then somebody may say this for ABC reason is not good, then it's okay. But I want to know why somebody bought an IPO, because like this recent IPO, I would not have bought it at 1/5 the price. I'm not telling you which one, but you know which one. Okay, so it is very interesting to see, अच्छा ये कौन बेवकूफ़ है जो ये लेके गया, उसका भी तो वो भी तो मज़ा आता है लाइफ में. So it's not necessarily every time to admire that he's bought it, but to say what a bunch of idiots and how they're wasting investors' money. But let's see how it does after day one. So this is part and parcel of our business, that in the end the universe is defined and you are screening and sorting them, so the help can come from anybody. Even like these newspapers, not newspapers literally, but these specialty like morning context, these kind of whatever we call them papers, they are writing on companies and bad companies, so all that we keep, because we didn't realize that ye point bhi hai, so that inventory has to be there for rejecting. For good, that's what I'm saying, for good this will not make sense. If somebody wrote a good report in a paper, or Sucheta Dalal, the good will have less value. But if she found something interestingly pokey, that is of interest.
And so I wanted to get your sense of balancing short-term views with longer-term views. And I'll tell you what I mean. For example, in specialty chem, a lot of feathers were ruffled recently because Lanxess, which is a large German company, sort of essentially withdrew guidance and said, look, things are bad. It's so bad we don't even know how bad it is. And so therefore there were, ripple effects around the world. But there is a much broader, larger thesis of China +1, and therefore specialty chem and chemicals will do well. So how do you, is it a question of dancing in and out?
No, so because we are long short, although this one I didn't react to, but in the long short fund, the good thing is that you can still keep your long and add something else to the short side. But for example, we say in general that we want our investments to be with a 1 to 3 year view, and then in multiples of 1 to 3 year. But it's not that straightforward. For example, our number one holding has not done anything for 3 years, which is HDFC Bank. But if somebody had told me that I won't do anything for 3 years, I may have thought differently. But you never think like that. Yes. You are confused and you say, "Nahi, theek hai, ab to yaar 1 year ke liye, 2 year ke liye, theek hai, but of course I haven't done anything for 3. But it's done very well for the previous, 20 odd years." So, in some, it all depends. See, what you do depends on what you have done. Or what you own. Some stocks, because you own, you will defend them a little bit more and say, nahi, I want to own. And if you don't own it, you will curse it and deliberately create. See, the one thing is, when people say, that I have no interest in this stock because I don't own it. It is the biggest lie.
Why is that?
Because if others own it or the index owns it, you have deep interest. Because for us to outperform, suppose the index has a stock which is very sort of falling and I don't have it, but actually I'm very enjoying it that it's falling because the index has it. So you could say that for another fund also, but let's forget about it. So the point is you are interested in everything, because if you don't have it and others have it and it's going up, it is hurting you, or the index has. Let's not even make it personal. Let's say. So in everything you are interested up to a point, unless it's a micro cap, small cap, and then you may say it doesn't matter. Best of luck to you. But what I have understood is that since 150 companies do well, and if I say that I don't like this stock because it's expensive or it has bad history, and it does well, that broadly doesn't bother me, because that means still I have 149 left I can try for. And broadly, I should get some of mine right. But otherwise, if a big stock in the index underperforms and I don't have it, that is free help for me, no? In the end, my goal is to beat the index first and then look at other things in life.
So do you pay a lot of attention to what other people are doing? And when I say other people, I mean other funds. Is it something that ever weighs on your mind?
No, sometimes it may do. See, these things happen if you're underperforming in some phase. Then we also, for example, our benchmark is MSCI India. But we don't subscribe to MSCI India data also, because we have been broadly outperforming. But in between, when we underperform, we say, देखो तो सही MSCI India में क्या है जो we are not outperforming it. So then we may look at the ETF of MSCI, from there we can figure out, because we still don't pay MSCI anything to know what is in the MSCI.
It's a phenomenal stock though, right?
Yeah, I own, by the way, the stock in my global fund. Yeah. But I'm not paying them. They want $12,000 for this in a year, $1,000 to give constituents and their weights. I can look at an ETF and get it myself. And beyond that, I don't want to know anything more about it other than the index weights and industry weights and stock weights. What I'm saying is, when you are doing well, you don't care. Sometimes you care. If somebody is doing significantly better, you want to know, what is he doing? How will you put pressure on your team, on the analyst, that how come that guy discovered this? You also went to the same conference or to the same road show or whatever. You have to see. But every day we have not needed, because we have done better. They are supposed to look at us. That is just so far.
Right. And so you see exactly the point you just mentioned, which is that sometimes you question that, we looked at the same set of facts and why did we come to different conclusions? And how do you, I don't say guard against, because often that is also your advantage, right? Seeing things that other people don't. So how do you, before the event, not before the event, but when you're buying, how do you know that whether you are you're seeing something other people aren't, or you're making a big mistake?
Actually, there's no answer to this question. So at Wharton, I studied this, that when trading is going on, there are two types of traders: information trader and liquidity trader. Okay, so some guys are trading because they have information, and some guys are trading because they either want liquidity or they have liquidity to invest. So he's buying not because he knows anything better, but he has got new inflow. If you thought that everybody is trading only on information, trading would stop. Because I'll say, I am buying, why is he selling? Let me check. But I say, no, he's selling because he has a redemption. Or he's selling because he's an idiot. Okay, so whatever. But you can't do every day by overly analyzing the other guy. Because if you analyze the other guy, you will stop You will stop to question, what does he know? So that we have not had in that sense. But actually, according to me, our strength is that we are not going in thinking that every dot has been crossed and I'm buying 8%. We are saying we have checked our factors. On none of those factors it is bad. On many of the factors it is good. We have also accepted that not all the factors will be good ever. For example, if there is an IPO and the company has just got listed, on what basis does the world say that we buy good companies with good management? Because we don't know whether it is good management when operating in public market. You may be good management in your hometown, I don't care. But as a public market, this thing, we will know 2, 3, 4 years later that you dealt with conflicts and this and that. So we say the management is not bad. But other things might be good, like the opportunity or valuations or whatever. Sometimes, like many of these guys would have bought, say, Indian hotels after COVID. Now, how can you say we buy good companies with high ROC and high ROE? The hotel is closed and you don't know when it will open and whether there will be a vaccine, but we can buy it. We say the results are not bad considering it is closed. But you could have a situation where the results are bad because it is closed. Because let us say it had a lot of debt before, and this debt is due, and you know that this fellow will not be able to handle 2 quarters of shutdown. Whereas some other hotel might be able to handle because while going in, he was in a better shape. So in the first case where the results are so bad, rest of the issues become irrelevant. The result is bad, story over. But if the result is not bad, at least don't go and fool yourself that you are buying high ROC and high ROE and high this, because you don't even know for how many. All we are saying is he can handle himself for 8 quarters. And we hope that in 8 quarters, these things would solve. But on what basis can we say it's very good? So we say not all the 8 factors will ever be good, but all of them have to be minimum not bad, and then some to be good. And therefore I also don't like people say we went in COVID time and we bought like mad. You are the biggest gambler that the world has seen. That you bought, you had no visibility, you had no idea, because it turned out right. You had to give it 3 months to see whether, because the future was dark, but you bought it because free ke paise hain, public hai.
Speaking of IPOs, there's this thing that's always intrigued me, which is, they may not explicitly say it, but there's this sort of, general understanding that the bankers and the company that's coming out will always leave money on the table for investors. So, but why do you think that there is a lot of people have that perception?
They don't anymore because of the PE guys. Previously, we were able to, when I was in Alliance and I was the biggest fund manager of India, I would tell the companies that you are, that time the company fellow used to own 100% or 80-90%. And we'd say you are selling 10-15%, give up 10% only of that, because fund manager is happy you make 10% on day one, and then rest you are okay. Now the other side is a financial investor, and he's just squeezing the hell out of it. I actually thought that the mutual fund industry should form a union. I think it's legally allowed to say in the press that we are not buying any PE funded IPO, go to hell.
But tell me something.
But they don't do it, I'm just saying jokingly, but absolutely right.
But this is it seems so obvious that they should not be buying. I'm not talking about any individual, I'm just saying in general. But you have the biggest name mutual funds on the QIB.
And some of them are known that these stocks will not work simply because it's very easy in some cases, not every case.
Yeah.
If last year when this correction happened, all the listed guys were down maybe 50, 60 or even more. Like Paytm had gone down from 2000 to at that time maybe 700-800, then it went down to 400. And then Zomato had gone down, not from the IPO price but from the high. So they were all down 50-60%. And still a new IPO came, which was maybe 50% higher than their last funding. I won't tell you the name. And I said there is not a chance in hell that this stock can open up. And the stock opened up and stayed up and finally is below the IPO price. Delhivery. Why did you need any deep research that when you are a manufacturing company and you raised your last money at some 100 rupees and in 10 months you are coming at 670 rupees. It is not that during this time you discovered cure for cancer, which means that suddenly your valuation went up. In manufacturing, you suddenly made 33 more planes or whatever you want to call these things. And it's a manufacturing company, so it's not that you discovered anything for suddenly pop, but the world is willing to pay 6-7 times more with a grey market of 40%.
It's not that, forget the retail. I'm saying there are fund managers with 30 years experience.
So that is why sometimes I like this, because we can only outperform if others underperform.
You're not outrun the line, you're outrun the other guy.
So one part of outperforming is that the other guy is like tennis.
Right.
You normally don't hit the winning stroke. The other guy just puts it in the net.
Right.
And it's that is enough. So once, in the olden days when people would come with stocks, which I used to think are bad, I used to say, I say, I don't like it. He'll say, sir. I said, no, you're a good man. You are my Trojan horse. Make sure that this stock lands up in other people's portfolios. So that was way off.
Right. So Samir, I just want to, end by talking actually about a post of yours on Twitter. A tweet. I think it was maybe a year and a half back, where you put a picture with Paul Tudor Jones, who is a very famous and I think there was, y'all technically, had he invested in your company at some point?
Yeah. He had 15% equity in Helios, yeah.
Right. So I'll tell you why I asked this question, because now I don't know exactly what his track record is in terms of performance, but my guess is your track record between Alliance and Helios is, broadly speaking, as good as any of these hotshots, right? But what I want to know is, when will the day come when, I don't want to sound overly unnecessarily patriotic or anything, but when the global guys will put a picture up with, a Samir Arora and say, look, today I got so lucky. Because I'm saying, I asked this question because,
No, the thing is, that is how the US system works. The US movie star, people will put Indian movie star, the Indians will put.
But I would argue that they're making a movie that is $2 billion versus something that is 100 crores. Out here, you are doing what he's doing.
No.
I'm saying in percentage terms.
So yeah, but the sizes are too big. Like, he was at the peak when he took a stake in Helios. I think they were managing $17 billion or something, and their fee was 4 and 27. So as one of the guys, how did you find this? We get the highest we could get away with, something like that. So वो तो अलग चीजें हैं. They are all very worth 7.
Tell me something. When you meet these people, do you think that you're talking to this guy and like this guy is either? I'm not talking about him specifically. I'm saying in general that, boss, I'm probably smarter than this guy. Again, I'm not talking about him specifically. I'm just saying.
I asked this question of one guy in Alliance, and he told my boss that Samir is planning to sue us, and I had no plan. So I asked a simple question to the big bosses. Right. I said, at bonus time I asked, I said, are you paying these bonuses for performance or the AUM of the fund manager? Because we had these US guys at that time who were managing, say, 2 billion, 3 billion, and they were 2-star funds. And we were managing 200 million and 5-star. Our size at that time was only this much, and US chotu, poor, bad performing fund was 2 billion. So who should get paid more? So he thought, because I copied HR, that I am trying to find a legal thing where they write something back. So he told my boss that, is Samir planning to sue us? And I said, no, I was needling the system a little bit to say. So there's no answer to this question. It's like when you are comparing yourself, it depends on, if you want to feel happy in life, you will compare yourself with an appropriate benchmark. We are not comparing ourselves with those guys whether are performing. We are comparing with our peer group and our classmates and our batchmates and moving on.
But on a more serious note, is it a function of the fact that you see the reason a fund can have 30 billion in AUM?
No, first of all, we can't have it also. Because we can't short it. I think we can't even have 2 billion in long.
So imagine tomorrow you're a long only fund, okay?
Only US.
No, I'm saying you are wherever in the world. Forget you. Let's say you get a global mandate, you can do whatever the hell you want, okay, tomorrow morning. I'm saying the reason you cannot get 30 billion is because the ecosystem doesn't exist. You don't have, there's no Harvard putting 1 billion and, Canada putting.
Also cannot handle big sizes.
So that's also, is it just the ecosystem has to grow? Are you seeing signs of that?
No, because our market cap is 2% of the world. Our market. So there are 2-3 funds which are 5 billion.
Out of Singapore only.
Correct. So one of them at least. So the thing is, that is a different game of a private equity type mindset, and you get it. But in the long short world, you're not getting that amount. And so when somebody asks me what is the AUM, I say normal or fee adjusted. So the point is different. These are different games. Yes. We are supposed to do better than the Indian peer. Where am I going to lose sleep over comparing with the big successful US? Let them be in their role. That's a different world. Yeah. Otherwise, you'll always be reaching There's no end to that.
Samir, thank you so much. This was absolutely fantastic. I hope next time you'll dress up properly for our interview. Thank you so much.
Thanks a lot. Very good.